How's it going, everybody? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. So today we're talking about Netflix and their Q4 earnings report. So everybody knows about the so-called streaming wars. The world of streaming is becoming faster and faster and becoming the go-to for how people watch their favorite content. A world where intelligent life has cut the cord is absolutely inevitable. So those who reign supreme in the beginning are certainly poised to have a long, prosperous rule. The traditional days of TV bundles are becoming somewhat of an endangered species, and the world of entertainment is experiencing the next stage of evolution here. The race to launch the most popular subscription service has never been more important than it is now. Now, some believe the king has already been crowned, while others believe the changing of the guard has just begun. One thing's for sure,
this Cold War just got pretty hot.
The conquest for streaming services has officially unveiled all of the heavyweights in this fight. And the list's actually quite impressive. So while there's dozens really offering up tons of different content in this fight, there's really only a handful that are going to stand a fight for true dominance in the future. So what we're doing in this video is taking basically a deeper dive into Netflix's Q4 earnings. We're going to highlight some of their main points and just kind of talk about what the company is doing moving forward. Do we believe it's undervalued as a stock? And what I generally think about the company. So before we get started, I'm just looking out the window and just want to let you guys know that we're doing absolutely fantastic here in Canada. We just got an absolute huge dump of snow, and it's damn cold. Okay, sorry. So up on the screen here, we have a snapshot of various non-GAAP financial measures. Non-GAAP just means generally accepted accounting principles. So my first observation is that the revenue growth year over year for each quarter is over 20%, which is absolutely huge. That's crazy growth. And they're not a relatively new company. They've actually been in business since 1997. I think it's important to note that this company isn't necessarily in the mature phase of their business cycle, but we can somewhat expect these double-digit growth numbers to kind of slow down over time. You know, how long can they maintain a 20% growth rate? That's quite a bit. They already have 160 million paid subscribers, which is industry leading. Their operating margins seem to kind of dwindle throughout the year, but you can kind of attribute that to their investment into their original content. Management in this company has reiterated multiple times that they will continue to invest into original content, and that will help them become self-funded over time. Instead of having to, rent popular TV shows or movies, they'll own all their original content and somewhat self-fund as those shows become popular. So global paid streaming memberships is also kind of in line with revenue growth. You can see it's well over the 20% year-over-year growth rate for every quarter for the last 4 quarters. So management for this company has kind of offered reduced guidance for the upcoming year, mainly due to the increased competition. So out there now, you have Disney Plus, you have the Amazon bundle, you have Apple's streaming service, you have Hulu. Netflix still is an industry leader, don't get me wrong, but there's a lot more competition out there that are withholding their original content from Netflix. So actually, at the end of 2019, Netflix lost all their rights to the Avengers series, to the Marvel content. So that's something that they're going to have to work on, and that's why they're investing so heavily in original content. So just at the bottom of the graph too, you can see Netflix's streaming content obligations in billions. What this is basically is how much they're paying for original content as well as for licensing of any other shows which aren't necessarily their content, but they're renting to put up on their streaming service. So that's kind of stayed consistent over time. At least for this year, it's near that 19 billion mark, but management has cited that it may increase over time. Next up here, we have a snapshot of the weekly global net ads for the company. So what this is how many paid subscribers that they add per week. So in 2018 and 2019, the company added almost 30 million subscribers both years. 2016 and 2017 a little bit lower, but you can see that their Q1 forecast is kind of in between all 4 of those years. This is probably Netflix's most crucial piece of information for investors, okay? As this number goes up, the stock price goes up, and that's basically the main thing that investors look at for this company. Many analysts believe that paid subscriber growth will actually be slowing down in the future, especially domestically. We'll get into the international versus domestic subscribers a little bit later on in the video, but just important to note that analysts believe that their paid subscribers in the US or in North America is actually slowing down quite a bit. The next snapshot I'm showing you here is something that management released with their Q4 earnings, and it's a major jab at their competition. So for any of you who know who Google Trends is, this is a snapshot of some of the original content that came from all of Netflix's competition compared against Netflix's Witcher. Okay, so basically what they're trying to show here is that their original content is superior to that of their competitors. This shouldn't really be a surprise when they have well over 100 million more paid subscribers than any other streaming service. So you can see the interest for The Witcher peaked right when it released, and it was way above The Mandalorian, which came from Disney Plus, and way above Jack Ryan. And it even stayed more relevant as the months went on. So that's what they're trying to show here, but to me that's not really a surprise. They have the most paid subscribers out of any streaming service, and this really should be in their favor when we look at things like this. But again, basically what they're trying to show, their original content is far superior to those of their competitors. It's also important to note that Netflix is the only pure play streaming company in this industry. If you look at companies like Amazon, Disney, this isn't their core competency. They're not necessarily in the production business or the streaming platform business. Sure, they have a revenue stream from it, but it's not their core competency. What Amazon's trying to do is sell things online. What Disney's trying to do is basically get you to go to their theme parks. And those companies, maybe not Amazon, but Disney's certainly in the mature phase of their business cycle and much more likely to grow through acquisitions than organic growth. Basically what I'm trying to say here, Amazon, Disney, Apple, much more diversified than Netflix. This is Netflix's industry. They're a pioneer and they are here to stay, really. Okay, next up what I'm showing you is Netflix's breakdown of revenues as well as global paid subscribers by geographical segment. Okay, so they've broken it down into 4 separate categories here. You have the UCAN, which is the US and Canada. You have the EMEA, which is the Europe, Middle East, and Africa. You have Latin America, which is LATAM, and then you have APAC, which is the Asian Pacific. What I kind of want to highlight here is actually how the North American or the domestic growth is actually slowing. In each quarter, they had less than 2 million net new ads, and in Q2 of 2019, they actually lost 130,000 subscribers. So despite the slowdown in domestic subscribership, they actually still have the highest average revenue per user, or ARPU for short. Again, I just want to cite that most analysts believe that domestic growth is slowing significantly, and most of the future value of this business will lie in their international subscriber growth. In total, the US-Canada geographical segment still accounts for the highest portion of subscribers when you break it down by 4 categories. But if you look internationally, they have a larger total of subscribers, just at a lower rate. So the North American customers have higher paying memberships and are worth more, but there's a larger number of total subscribers outside of North America, which is what's shown in this next picture. So again, international subscribers contribute less to the margin than domestic subscribers do, but they have a larger number of total subscribers as shown in this graph. Most people in North America are very aware of what Netflix is and are likely subscribed already or using somebody else's account. So that's also something I want to highlight here. As technology gets better and these streaming giants are able to identify who is actually paying for an account versus who isn't and in which household, that's certainly an opportunity to grow their revenues quite a bit. I still believe that technology is probably quite far away. You can't really fault people who share Netflix accounts. It's a great way of saving money. It's kind of like carpooling basically. But anyways, what I'm trying to say is if any of these streaming giants are able to correct this in the future, it's easily a way to double or triple their footprint domestically and internationally. Not that I'm advocating for that. Okay, so what's the purpose of all this information? Why am I telling you all this stuff? Basically to decide whether there's true value in Netflix. The stock is well over $300 already. They're valued over $150 billion. Should you really be investing in a company that's coming potentially to the end of their growth phase? They face much more competition than they did in previous years. However, their competition aren't pure play streaming giants. This is Netflix's core competency, and really they're the only one in the industry like that. Companies like Disney, Amazon, AT&T are large conglomerates. This isn't their main business. It's a side business. It's a way for them to, wow investors with another stream of income. This is Netflix's main business. They're a pioneer in this industry, and they're very likely to be a leader in this industry for years to come. Netflix may have over $10 billion of debt, crazy high financial ratios, and tons of competition, but they remain the only pure play in this industry, and they have the most paid subscribers and will continue to have the most paid subscribers, in my opinion, for a long time. Netflix is going to be a company that has tons of value long term, but not a lot in the short term, okay? So if you're a short-term investor, you're looking to get, high return in a matter of a year or two, this is probably not the stock for you. If this is something you're looking to buy and hold for 10 to 20 years, there's tons of value, in my opinion, in this stock. They're going to be a major player in the streaming world for years to come, and will maybe be the most dominant production creator. In my opinion, Netflix is and will be the industry leader for years to come. Okay, so that's all I have for you guys today. I hope you enjoyed. If you did, don't forget to smash the like button, subscribe to the channel if you aren't already, and I will see you guys in the next video. Peace out, guys.